Hey, what's going on, guys? Today I want to shoot a quick video showing you how to use Robinhood to sell cash secured puts. So just want to throw a disclaimer out there. Please use this video for educational purposes only. I'm just making this video to show you how you can use their particular platform. So there's tons of different brokerages out there that you can use. What's unique about Robinhood is there's no commission for these options that you might sell compared to other brokers such as like TD Ameritrade, Fidelity, Vanguard, where there might be a small commission fee that you have to pay per trade. So typically it's 65 cents or somewhere between 65 cents and $1 per trade that you could pay. So Robinhood, pretty much says, hey, if you use our platform, you don't have to pay that fee. Now, from my experience, you're going to get not as good fills, but that's something you'll find out later down the road. But Robinhood's a great platform to get started. Please make sure you understand your risk, and I'm going to quickly go through my opinion of my experience with selling cash secured puts so far, and how you can use them as a trading strategy for your portfolio. So let's go ahead and dive into it here. So this is the Robinhood platform. This ticker is SHOP. It's Shopify. It's a online e-commerce platform. So, you can do this strategy on individual stocks and ETFs, as well as futures, but that's a little bit more of advanced. I don't personally have experience with doing that on futures. I just stick with individual stocks and, popular ETFs such as like SPY, QQQ, DIA, IWM, just a couple there. As far as the ETFs go. So pretty simple process. A cash secured put is essentially what you have to front to open this position is the cash. So cash secured put. So you're putting up the cash. So in this example, selling a $43 put, it's going to cost us $4,300. In order to open this position. So for this account, I currently I have a couple other positions on, so I don't have the buying power of $4,300. So if I go to execute this order, it's going to say not enough buying power, which is fine. So in order to do this, open this position, like I mentioned, I'm going to have $4,300, and currently it's going for 85 cents. The bid is 84, ask is 85, so pretty tight bid-ask spread there, so that's good. There's a lot of volume since it's right at the money. The chances of assignment are pretty high. It's Monday, the day that I'm recording this, and it doesn't expire until Friday, so there's 4 days. So definitely a lot of things can happen as far as stock price movement goes in 4 days. So that's why the risk is high. Because you're at the money. You don't have a runway. You have 35 cents before this option is in the money. And essentially, come Friday, March 10th, if this stock is below your short price of $43, you will be assigned 100 shares. So essentially, that's what a cash secured put is. You're saying, hey, at $43, I'm willing to buy this stock for $4,300. So there's a option buyer out there, like on the other side of this, saying, hey, I'll pay $84 hoping that it tanks, right? So somebody out there has bought this option that you're selling. So hopefully that's not too confusing, but high level speaking, as an option seller, I'm selling cash secured puts, so I'm fronting the capital. So you have to front $4,100, and you pretty much don't get that money back until either the option expires or you buy it back for either a debit or credit. So as a option seller in this particular option strategy, you're hoping it goes up. So as you can see here, Robinhood shows a quick little display as what the expected profit and loss is based upon what the price of Shopify is at come expiration. So March 10th, if Shopify is trading at $41.51, you can expect to collect a full credit because it's going to expire out of the money, meaning above $41. So if it's below $41, then it's considered in the money. So you're selling, out of the money option about $3.43 here. You're selling 100% extrinsic value because it's not in the money. That's something a little bit further. If you want to get more advanced of the option pricing, extrinsic value is pretty much the volatility and the time that is left before the expiration date. Intrinsic value is pretty much how much that option is in the money. So for this instance, it's out of the money. So its intrinsic value is 0. Whereas the intrinsic value of this option is it's $9 in the money currently because it's $43.50. So its intrinsic value would be $9. But as this moves, the intrinsic value is gonna, change as well. Same thing with extrinsic value. Look at the theta. This is how much the option is going to decay every day. So there's many things, as you can see, that go into options. You have gamma, theta, vega, RHO. I'm not sure what that is. But lots of different Greeks that make up this option and pretty much determine the pricing of it, how much it decays, and so on. So what I like to look at, Robinhood does a pretty cool thing here. They show you your chance of profit, and pretty much how they're determining that is they are looking at the delta. And the delta, this 16 says you're selling a 16 delta. So that's pretty much how much, so delta of 1 would be 100%. So you're selling a 15, almost a 16% delta, meaning your chance of profit is 84, almost 85% there. Whereas, 42, this is going to be a 27 delta. So these two are going to add up to $1 or 1.0. So, the further out of the money that you go, as you can see, your higher chance of profit increases, right? So 91%, 88%, 84.75%, 80.95%, and so on. So that's something that, do keep in mind that, the closer you get to expiration, these numbers can change really quickly. And your gamma is what's going to, move that number very quickly. So from my understanding, the closer you get to expiration, so let's just look at an example here. So the $40 put has a 0.0573 gamma. Now, if we go a week out, an option at that same strike has a 0.0612 gamma. And a little bit further, 0.0548. So that's really not a good example. From my understanding, as you get closer to expiration, the gamma is going to get higher because you're at a higher risk of a gamma risk, meaning that any sharp movement right before can move your delta very quickly. So look at the chance of profit. That's a good thing to measure, but do keep in mind that can change, fairly quickly there. Don't think that, 97% profit is always going to be like that, because if there's a big down movement, this can quickly change to 70, 80%. So yeah, just keep that in mind. But yeah, Robinhood shows a pretty cool, display here, chance of profit, 91%, and you're selling like an 8 or 9 delta. So, and this is actually the position I have on right now. So I had to front $4,000, and as long as Shopify, stays above $40 before March 10th, which is in 4 days, I'll get to receive the entire credit that I initially sold when I opened this position. So, what are the pros with, cash secured puts? You can make money in a sideways market, right? So like, for example, let's say that Shopify started the week out at $43.49. 5 days later, it went up, it went down, went up, went down, and then it ended at $43.48. So it's pretty much a flat week, right? There was some upward movement, downward movement, but it ended up being flat. If you would have just bought 100 shares, you would have made essentially $0. Whereas if you sold a cash secured put, earlier in the week, you sold it, got a credit of $20, $25, you're going to make $20, $25 as long as it stays above $40. It can go down to $42. And it can go down to 42 or 41, and it doesn't really matter. You're still going to collect that free, that premium there. I don't want to say free because it did cost $4,000 to get into that position, but that's just kind of what it takes to get that premium there. So I hope that makes sense. I didn't want to go too in depth because this is just a beginner video. Disclaimer, not a financial advisor here, but just kind of documenting and want to talk about like my experience and how I view cash secured puts and different ways to use it. Some of the cons, in a bullish market, right? And that's happened to me sometimes. Like, I've sold a cash secured put a couple dollars out of the money, meaning that, I had to front this capital and I defined my max amount of money that I can make. Whereas if I would have just bought 100 shares, the upside is uncapped, right? So, you can put in 4,000. I mean, obviously right now, Shopify is probably a bad example. It's dropped $7 for the past month. So typically I like to do this. I like to do, fundamental analysis of stocks that, I wouldn't mind owning long-term. So like they got to be good companies that, sometimes they pay dividends, sometimes they don't. But do keep in mind, selling cash secured puts, you are running the risk of getting assigned 100 shares. So if you don't like the stock or you haven't done research on the individual stock, you could be putting yourself in a situation of, owning 100 shares of a company that you don't really have much interest in owning. So only do this on, stocks or ETFs that you like long-term, or, just make sure you have an exit strategy. So this is part of the wheel. I'll make another video on the covered call side, of the wheel, but this is just one part and essentially step one. So you continuously sell covered cash secured puts until you're assigned. And then you turn around and either sell those shares back for a profit, or you sell a covered call above your cost basis to pretty much flip the wheel, and then you start selling covered calls. So, but stay tuned for that video. I'll do another one on that and just kind of the next step if you ever do get assigned on your cash secured put. So I want to talk about some other ones. So like SPY is a popular one, but the problem is that it is a fairly expensive, ETF, meaning 100 shares is going to cost you $40,000. Same thing with the NASDAQ 100. 100 shares of that is going to cost you right around $30,000. Some other ones you guys can look at, do your own research. XLK is a technology sector ETF. It targets the select sector spider fund. S&P 500 is technology companies. That one's a little bit cheaper, $14,000. You can do individual stocks as well. Apple, Microsoft, they are both kind of expensive, but a little bit cheaper than $40,000. ARKK, I've done this one before, but do understand your risk and your direct exposure to Tesla, pretty big holding there. But yeah, so don't, make sure you, like I mentioned earlier, make sure you want to hold 100 shares of this stock if you ever sell cash secured puts, because essentially that's what you're taking the risk of doing. So I think that is it. Another thing I'd like to look at, make sure it has good volume. XLRE is a pretty good one if you want the real estate, sector as part of your portfolio. Performance hasn't been the greatest, but that's just another one you could run the wheel on. The only downside with XLRE, and this might be something you come across with other stocks and ETFs, is that they only offer monthly contracts, whereas a lot of popular ones offer weekly contracts, which is really good. But in this instance, you can only do one per month theoretically. So do keep that in mind. Make sure you're doing this on stocks that have higher volumes, higher open interest, just because it helps getting in and out with smaller bid-ask spreads of these positions. So yeah, guys, that's it for today's video. Sorry it's a little bit longer than normal, but if you have any questions, feel free to leave them down below, and like and subscribe for more content.